Have you ever wondered why the government keeps increasing the interest rate? It's a question that piques our curiosity, isn't it? Because you see, understanding this financial phenomenon is not just for economists and policymakers. It's something that affects us all. Interest rates, these seemingly simple percentages, have a profound impact on our daily lives. They influence our spending, our savings, and even our dreams of owning a home or starting a business. Intrigued? Let's delve into the world of interest rates. Interest rates aren't as complex as they might seem. They're a fundamental part of our economic system, affecting everything from your personal savings to the health of the national economy. So what exactly are they? In its simplest form, an interest rate is the cost of borrowing money. It's a percentage of the loan that borrowers pay to lenders as a fee for using their money. Imagine borrowing a book from a friend. In return for letting you read the book, your friend might ask for a small favor. That favor is akin to interest. Now let's dig a bit deeper. You might have heard of terms like prime rate, federal funds rate, or mortgage rate. These are all different types of interest rates, each serving a specific purpose. For instance, the federal funds rate is the rate at which banks lend to each other overnight. This rate directly influences other rates like the ones on your credit card or mortgage. But how do interest rates affect the economy? Well, they play a crucial role in managing economic growth and inflation. When interest rates are high, borrowing money becomes more expensive. This encourages people to save rather than spend, slowing down economic activity. Conversely, when rates are low, borrowing is cheaper, encouraging spending and stimulating the economy. It's not just consumers who are affected. Businesses also borrow money to fund expansion projects, buy equipment, or manage cash flow. When interest rates are high, these activities become costlier, potentially leading to slower business growth. On the flip side, lower rates can spark business investment and growth. Interest rates also have a global impact. They can influence foreign exchange rates and international investment. Higher interest rates can attract foreign investors looking for better returns, strengthening the local currency. Conversely, lower rates may deter foreign investment, possibly weakening the currency. In essence, interest rates are like a thermostat for the economy. They're used to heat things up when the economy is slow and cool things down when it's overheating. It's a delicate balancing act that requires careful monitoring and adjustment. Now that we've got the basics down, let's explore why the government might increase these rates. The government doesn't just wake up one day and decide to increase interest rates. There's a method to the madness. First, let's talk about inflation. This is when the cost of goods and services in an economy increases over time. A little bit of inflation is considered healthy, but too much can be detrimental. When inflation starts to run too high, the government steps in and raises interest rates. How does this work, you ask? Well, by increasing interest rates, borrowing money becomes more expensive. This discourages people and businesses from taking out loans, which in turn reduces spending and slows down the economy, bringing inflation under control. Next, we have to consider economic stabilization. When the economy is booming, it might seem like a good thing, but it can actually lead to problems. If growth is too rapid, it can create bubbles in certain sectors, like real estate or the stock market. When these bubbles burst, it can lead to a recession. To prevent this, the government will raise interest rates to slow things down a bit. Additionally, high interest rates attract foreign investors. When foreign investors see a country with high interest rates, they want to invest their money there to get a higher return on their investments. This increases the demand for that country's currency, which can strengthen it. Now, let's talk about government debt. Countries often borrow money to finance various projects, and they have to pay interest on this debt. When the economy is strong, the government can afford to pay more interest. So, they might raise interest rates to help manage their debt levels. However, this is a bit of a balancing act, because if interest rates are too high, it can make it harder for the government to pay back its debt. Lastly, there's the matter of economic inequality. Higher interest rates can actually help reduce economic inequality. This is because when interest rates are low, it's easier for wealthy people to borrow money and invest it, increasing their wealth even more. But when interest rates are higher, it's harder to borrow and invest, which can help to level the playing field a bit. So as you can see, the decision to raise interest rates isn't taken lightly. It's a tool that the government uses to manage the economy and keep things balanced. It's about controlling inflation, stabilizing the economy, attracting foreign investment, managing government debt, and addressing economic inequality. Sounds complex, right? But how does this affect you and me? So, the government increases interest rates to help the economy. But what does that mean for us? The first thing that springs to mind when we hear about interest rates going up is probably our loans. For those of us with variable rate loans, like a home equity line of credit, an increase in interest rates means the cost of borrowing goes up. That's because the interest part of our loan payments will increase. So, we might find ourselves paying more each month or the same amount for a longer period of time. It could mean tightening our belts and cutting back on other expenses to accommodate this increase. But what about those of us who don't have loans? Well, higher interest rates can affect us too. If we're savers, higher interest rates can actually be a good thing. When interest rates go up, so does the return on our savings. The money sitting in our savings account will earn more over time. It's like getting a pay raise, but for our savings. So for savers, an increase in interest rates could mean more money in our pockets. Now let's talk about investments. If we're invested in the stock market, higher interest rates can have a bit of a mixed impact. On one hand, companies might find it more expensive to borrow money to fund their growth, which could slow down their expansion and potentially their stock price. On the other hand, some sectors, like banking, can actually benefit from higher interest rates. So, the impact on our investment portfolio could depend on where we've put our money. But wait, there's more. If we're planning to buy a house or a car, higher interest rates can make these big-ticket purchases more expensive. That's because the loans we take out to buy these things would come with a higher interest cost. But if we're planning to sell a house, higher interest rates could mean fewer buyers on the market, which could affect our selling price. And finally, if we're retirees living off our savings, higher interest rates could mean more income. That's because the interest we earn on our savings or fixed income investments would go up. So, higher interest rates could mean a better standard of living for us. In essence, whether higher interest rates are good or bad for us depends on our individual circumstances. Are we borrowers or savers? Are we investors or spenders? Are we planning to buy a house or sell one? Are we working or retired? The impact of higher interest rates can vary widely based on these factors. All right, we're beginning to understand this. But what about the bigger picture? The ripple effect of interest rates goes beyond our individual wallets. You see, when the government increases the interest rate, it doesn't just affect you and me. It has a broader impact on the economy as a whole. And this impact can be seen in various sectors, such as businesses, jobs, and the housing market. Let's start with businesses. When interest rates rise, the cost of borrowing also increases. This means that businesses may find it more expensive to finance their operations or expand. Higher interest rates can make it more challenging for businesses to repay their loans, leading to a decrease in profitability. This can slow down economic growth as businesses may delay investment or cut back on production. Now, what about jobs? You might be wondering how interest rates could possibly affect employment. Here's the connection. When businesses are hit by higher borrowing costs, they may need to make cutbacks. Unfortunately, this often means reducing their workforce, so an increase in interest rates can potentially lead to higher unemployment rates. But it doesn't stop there. The housing market is another area that feels the pinch when interest rates increase. As interest rates go up, the cost of mortgages also rises. This can make it more difficult for people to afford to buy a home. And when fewer people are buying homes, this can lead to a decrease in house prices. However, it's not all doom and gloom. Higher interest rates can also have some positive effects. For instance, they can help to curb inflation. When borrowing becomes more expensive, people and businesses tend to spend less. This decrease in spending can slow down the economy, which in turn can help to keep inflation in check. Furthermore, higher interest rates can attract foreign investors. When a country's interest rates are high, it can attract foreign investors looking for better returns on their investments. This inflow of foreign capital can help to strengthen the country's currency. So, you see, the impact of interest rates on the economy is a complex web of cause and effect. They can influence everything from the profitability of businesses to the job market, to the housing market, and even the strength of the country's currency. In conclusion, when the government increases the interest rate, it's not just a number on a piece of paper. It's a powerful economic tool that can have wide-ranging effects on the economy. It can affect how businesses operate, how many people are employed, whether or not people can afford to buy homes, and even the value of our currency. But it's important to remember that these effects are not always immediate. They can take time to filter through the economy, and while they can create challenges, they can also present opportunities. So, it's clear that interest rates hold a lot of power, but is there anything we can do about it? Well, that's a question for another time. For now, let's just say that understanding the impact of interest rates is the first step towards navigating these economic waters. Although we can't control the government's decisions, we can control our own finances. Today, let's delve into some strategies you can employ to navigate the stormy seas of rising interest rates. First off, let's talk about saving. It's a simple concept, but in times of high interest rates, it becomes even more crucial. As interest rates rise, the cost of borrowing goes up. So it's a good idea to have a solid saving habit to depend less on borrowing. Moreover, having a healthy emergency fund can provide a safety net in uncertain times. Next, consider revisiting your debt strategy. If you have loans or credit card debts, higher interest rates mean you'll be paying more over time. It might be a smart move to pay off any high-interest debts as quickly as possible. Remember, the less debt you have, the less impact these interest rate hikes will have on your budget. Then, there's investing. While increased interest rates might seem like a bane, they can also be a boon for certain types of investments. Bonds, for instance, tend to do well when interest rates are high. So, diversifying your investment portfolio to include a mix of different assets can help mitigate the impact of rising rates. Another useful strategy is to consider refinancing. Refinancing your mortgage or other loans can potentially save you a significant amount of money, especially if you can secure a lower interest rate. However, do remember to weigh the costs, such as potential penalties or fees against the benefits. Lastly, consider seeking professional advice. Financial advisors can provide valuable insights tailored to your specific situation and help you navigate the complexities of financial planning in a high-interest environment. Now, as we wrap up this segment, it's essential to remember that everyone's financial situation is unique. What works for one person may not work for another. Therefore, it's important to understand your financial position, set clear goals, and create a plan that suits your needs. And remember, while rising interest rates can pose challenges, they also present opportunities. With the right strategies in place, you can not only survive but also thrive in a high-interest environment. So don't let the fear of rising interest rates deter you. Instead, see it as a challenge to better manage your finances, to save more, invest wisely, and ultimately become more financially independent. Remember, knowledge is power, and now you're a bit more powerful. We've traveled quite a distance today, haven't we? From unearthing the mystery of interest rates to understanding why governments opt for their increase. We've seen how it's not just a random decision, but a calculated move to control inflation and stabilize the economy. We've also delved into the personal impacts of these changes. Remember how we discussed that higher interest rates could make your loans costlier, but could also mean more returns on your savings? It's all about finding that balance. Next, we ventured into the macro view, looking at how these interest rate changes ripple through the economy. affecting everything from your personal pocketbook to the nation's GDP. Finally, we explored some strategies to manage these impacts, like budgeting, investing wisely, and staying informed. So the next time you see a headline about interest rates, you'll know exactly what's going on. Until next time, stay financially savvy.